Hello, everyone. Welcome back. And thank you, Marcel, for reminding me to mention this is Trend Following Plus Nothing Ideologues Dangerous Cult Attack Session. And I don't think we are, we're not dangerous. Good morning, Oleg.
Hi, Jerry. Hi, Brian. Hi, Maurice. Hi, Richard. Hi, Bruno. Hi, Absolute. Hi, Marcel. Andrew. And Josh. Good Josh. Hi, Josh. Hi, Debone. Yeah. Hi to everyone. Of course, I'm very happy to see here. It's not a secret, I think. So, back to Novorossiysk and already missing wild forests, bears and wolves. It's a joke, there was no bears, but one guy said that deep in the forest he met a bear, but he wasn't aggressive one. So, okay. This week I was very impressed by a conversation between Jerry and Mike Medicinos and their Stock and Trend podcast. And I was really very impressed. I'm impressed every time. I have said it before many times that every time I listen to something with Jerry, I'm really very impressed. So, and I would say that I like very much the phrase of Jerry that there is no evidence ever that yes, I see this. There is no evidence ever that adding something to your trend following system that reduces or adds to the position based upon correlation or volatility increases that trade. And also Jerry said that the ACTAs do it, but they never said that all that non-trend things that they do improve the trade. Never, because it doesn't, and they wouldn't lie. Yes, and I fully agree with this. I fully agree that all the methodologies, so these guys do something marketing things and so on and so forth. But of course, if we are talking about improving trend, there is no evidence. I agree fully with this, and I have done many years ago, 5, 6, 7, 8 years ago, a lot of different researches, and so I agree with this. That the best way is classical one-phone approach, long-term approach. It's really so. Let's get started. Of course, hi, Absolute, by the way. I'm very happy. Hi, Bruno. I see you here. I'm very happy to be here, as I have said. I say this every time, and I have said it today. I don't remember. Okay, let's get started. Our trend following plus nothing ideologies, dangerous cult attack session. Okay, let's get started.
Thanks, Oleg. You make me laugh. You did a really good job there. I want to go camping or hiking with you one of these days. So I'm going to try to keep, another thing I need to do too is to keep my mention of any products to a minimum so I don't get in trouble with compliance. Compliance is sending me a lot of emails. Yeah, I don't like those emails. So I need to not do that. Education only, no advice. Yeah. So anyways, Richard, how are you? I'm tempted to always say good morning, but it's not good morning. You know, our good friend Alp.
It's a good evening. Yep.
Yes, exactly. 14 hours ahead, I believe. And our good friend Alp is here in town, and I'm going to visit with him today.
That'd be
weekend,
great.
So that's going to be fun. And we met up last year in a pub in London. Had never met Alp. It was totally fine and safe, just like this year when I met up with Marcel in Versailles, France. So you never know where I'm going to show up with and meet up with our little underground cult ideologues. But why don't you tell everyone what we have planned in Australia next month?
Hello, everyone. Look, so what we're doing, we're initiating the Aussie Turtles project down here in Australia. So Adam Haverliv and myself, we've started up this initiative called the Aussie Turtles, where we are seeking to sort of increase awareness of the classical trend following methodology, particularly to Australian investors. But also we're using this as an opportunity to sort of keep the Turtles brand going and hopefully, we'll be able to get over to Europe and over to the US, etc., to get involved with, say, Jerry and Moritz over in Europe or whatever, to really sort of increase awareness of classic trend following that we talk about here at Spaces. But look, what we do have coming up in November, for those who are going to be in Sydney, is that on the 16th of November, on a Thursday, between 6 p.m. to 8:30 p.m, we are hosting an evening with Jerry Parker, Moritz Siebert, Moritz Hayden, and Adam Havrelev, and I'll be emceeing on the night, where we'll be having a panel discussion for about 45 minutes, and people will be able to come there and enjoy canapes and lots of great wines while they listen to this, and then meet with us all and discuss the turtle story and classic trend following in a great environment at Bebo's Wine Bar, which is down in Double Bay in Sydney. It's a beautiful venue. It should be great fun. It's a free event for those who can make it. We hope to get some of you, hopefully, if you're Australian-based or Sydney-based, to get down there to meet us all. So that's where we're going to be on November the 16th. So looking forward to seeing as many of you as we possibly can. So the way to getting to register your interest for this is we have a website called AussieTurtles.au. So it's AussieTurtles.au. If you go onto that website, you'll find details about the event, and click on that and then register your interest. We've got about, I think, a seating of about 60 people there. So, first in, first serve. Obviously, with the list that we get, we might have to, unfortunately, tell some people if they don't get in that they unfortunately won't be able to make it. But look, we hope to see as many of you as we can, and it gives me and Moritz and Adam and Jerry a chance to get together as well over the few days that they're going to be in Sydney, and thrash out this classic trend following and get some good things happening with it. So looking forward to that.
Absolutely. We're looking forward to being there and hanging out with Moritz, who we've been in the same city and hung out together a few times in the States and in Europe once. I think Moritz drove halfway across Europe to have dinner with me one night, and Lisa, and that was fun. And then Miami. But we got to get a lot of people to Miami at the end of January as well. I think there's going to be a big meetup down there with lots of fun things to do. But I'm definitely looking forward to being back in Australia, hanging out with Richard, Adam, and Moritz, and everyone down there, the Aussie Turtles. Going to be a lot of fun.
Hope you like the Australian wine, Jerry.
Exactly. I love all wines, especially Australian. I've had it here in the States. I've ordered it, and bought it on wine auctions. So I know that it's really good stuff. And so, yeah, I'm very open-minded about all things wine. Now, I did want to also, I have promised to lay off Mr. Harris a bit. And I did enjoy his articles this week. I mean, they're kind of interesting. And, one of the things I find that in his article, in all articles, even if I kind of overall have an issue with some of the parts and stuff, of course I would have an issue. Of course I might be incorrect, but is that they bring up a lot of good points. And one of the things that he brought up in this latest article about trend following is luck, and how big a part luck plays, and that you have all these choices about trading and how to trade and all that. And, he opened my eyes a bit, because I guess I wasn't really thinking that clearly about how many choices we have. And so it's all of the different components, and it's a lot more than one entry, one exit, and a stop loss. It's lots and lots of other things we have to make choices of and sort of optimize and decide how we're going to trade. And so he makes this point about there was this. He comes up with a couple of different systems. One's a long-term system, one's a shorter-term system, And the longer term system, according to his results and backtesting, is better. It's better. It makes more money, has a lower drawdown. I think it's real numbers and not just an example, but it's a great example nonetheless. But he also points out that in one particular year, the return for the shorter term system was like over 70%, and it far greater than the longer term system, which may be 20 or 30%. So it sounds like 2008 or something like that, which I had this similar experience where my performance was below average because of my limitation on the shorts and my longer term strategy. And I favor, I have this filter that gets in quicker if it's a consolidation. And then, so back in 2008, a lot of these trades were just V tops and they just crashed. So I got in late, slower than most people, blah, blah, blah. So, anyways, he goes on to say, because of this sort of bad luck and the headlines that this 70-some% performance would have gotten, people would have really thought, wow, what a great trader. But he's basically just trading an inferior system, and it happened to work a lot better over this one particular year. And I think that when I was in the turtle class back in Chicago in the 80s, this was one of the main points that they would bring up was the impact of risk, of luck, and how long you can go seemingly with underperforming and it only being due to poor luck and overperforming. And I've said a lot on this spaces that it's shocking how long a bad idea can look good, and vice versa, how bad a good idea can look. And so I think that this was a really good point that he made, that we have to look at the back test. And I think that's the most important thing is this robust back test. And, even with his example of so many things to choose from and so many things that you can optimize, I don't ever discount adding more and more things like vol management, correlation management, dynamic position sizing, and all the other things that looks like gets added to these systems, these in managed futures. I don't think just because there's a lot of, if you just stick with classic, that you may be surprised at how many things you can optimize. I don't think it is an excuse to sort of optimize even more. But I did enjoy that article. Does anybody want to comment on that?
I want to only say that, and I have mentioned before that there is an old Russian saying that there is a better to lose something with smart friend than to find something with a dumb one. So it means that for our situation, that it's better do the right. So I only mean that, okay, I only mean that, and we all know this, I think, nothing new, that we have do the right thing, do the hard thing is a perfect formula, because in the long term, we will be, like Jerry said, do what computer says will make you the most profit. I think so. So a lot of system, especially short-term system and a real-term system, they look good in a period of 1 or 2 years, but not all of them are really as good as they can be looking for 1 or 2 years, because and probably 3 years. As I remember, Niels said once that 1, 2, 3, and not more, as usual. It looks better maybe than our system, and I agree with this, because people must understand such a thing as a hidden risk, and it's very important because when something happened, people began to understand that the risk was there. And it's better to understand this before something happened. And I love our trend following system because there are no hidden risk in classical trend following system. There is no hidden risk at all.
How are you, Moritz?
I was just smiling at the very beginning when Jerry, I think, said we're not dangerous. That's right, we're not dangerous. We are endangered. That's the thing. There isn't that many of us left doing it that way. So yeah,
Should we
endangered
call
species.
ourselves the Takahes? Do you think we should call ourselves the Takahes, Moritz?
Yeah, exactly. That lovely chubby little bird that just makes it very resilient. Love that bird, and it looks much better than the kiwi, anyways, I think. So yeah, looking forward to seeing everybody in Sydney. We add that to the list of cities where we hang out. As Jerry mentioned, we've met a couple of times. Also in New York, by the way, together with Niels, where we had an event, I think 4 or 5 years ago, with a bunch of people interested in systematic trading for a weekend. Chicago, had a dinner there. By the way, I really miss your the Richmond office of Chesapeake. That was really really nice. Yeah, no, I had a great week. Performance wise, up and down. The week started a little bit down, and then yesterday was a big turnaround day, where all of a sudden, sometimes this is so beautiful. Everything works at exactly the same time. Yesterday was one of these days where you look at the P&L, it's kind of like, wow, this was big. So yesterday was good, up for the month now, and let's see what today brings. Yeah, with regards to Michael Harris, I guess we'll touch on that as the space progresses. I'm very keen to touch on some of the points that he mentioned with respect to like Sharpe ratio, or adding more markets leads to reducing return reduction or raw return reduction. I really don't agree with that, but I guess we'll get into this as we continue.
Yeah, that's a good point. I did want to bring that up, and I think that I needed to have a more nuanced response to that Sharpe trend following and Sharpe. And I did admit that the Sharpe will definitely improve the more markets we add, although I don't target that. It's an accident. It's a welcome accident and I think that's kind of the main benefit of you can trade a bit larger. I think that's sort of just money management 101. If you trade 20 markets, you have to trade smaller than if you trade 120. That's kind of it's kind of the issue, kind of like issue number one with systematic trading, is that you want to trade systematically and rules based and trends, so you can start adding all of these markets, and you don't have to be an expert and a fundamental expert, and so you can go beyond a few stocks with the S&P and start adding more and more, and then you sort of start sizing them smaller and smaller. But then at some point you realize, I can either increase my leverage to get the same return with a lower drawdown, with the same drawdown, or I can keep my leverage the same and just have a lower drawdown. And so that's a beautiful choice that we get to make as we increase our diversification. And certainly with adding more and more markets and this big, huge fundamental principle that we multiply the number of markets by 10 to 15%. I never, etched in my mind is Richard saying, I think it might be 13. Yeah, of course. I'm never going to forget that for as long as I live. How critical is that for me? Is it 10? Is it 13? Is it whatever it's going to be? If I trade 300 or 30 markets, I multiply that number by 10% to get a possible average outlier. And I'm going to be able to smooth out my returns each year the more markets I trade. I'm not going to have, I'm going to reduce the ability to have this unlucky period where I may have zero outliers, especially if I trade 10 or 20 or 50 markets. That can easily happen. And so now, however, I guess one of my major complaints about the Sharpe has been that it doesn't translate into risk of capital and of losing money. And I think that I needed to moderate that point of view, because I think that it can, and I think it can for trend following. It doesn't for me because of one critical factor, and I can't see a way around this. So if you only trend follow or if you trend follow like managed futures, absolutely Sharp is a problem. Plus, they're the only ones with these marketing departments. I mean, I don't know about the rest of you guys, but my marketing department is pretty small. And whoever would claim to be in this marketing department has multiple jobs and that are not associated with marketing, let's say. So maybe, okay, so if you're using current AUM as your trade level and to size your trades every single day, then I think that's a huge mistake. And you do need to be very careful, and you probably do want to make a second mistake, which is to vol manage and correlation manage, and to cut back quickly when this vol heats up as a potential problem possibly is looming, especially if the vol is bad vol, meaning you're losing money, and vols are expanding. And I think that in that particular situation, the Sharp may be giving you a hint and a signal that, wait a second here, this is starting and possibly could translate into risk in the portfolio, losing positions because you have sized up recent trades to using the current very large possible AUM because you've made lots of money. And so now I have confidence in saying this, number one, because it makes sense to me. And number two is because the other Bruno, who used to be on Spaces and I think is from Italy, he told me this is absolutely true. He said, all bets are off if you're using the closed trade equity, the realized balance, as your AUM. That is another ball game. Yes, you have won on this, Jerry. Congratulations. Everyone else, Sharp is a decent measure. Even the managed futures trend followers, unfortunately, because they're not letting profits run and they're taking profits off the table and they're normalizing that distribution more than certainly than we are, and maybe normalizing it to a point that is detrimental to not paying if you don't pay attention to Sharp. What do you think, Moritz?
I agree. And I want to come back to, I think what's been missing from Mike's article is really sizing and how we would do that in a portfolio context as we add more markets. I mean, let's have a look at three very simple examples, kind of duplicates, but not real duplicate markets in my portfolio, you could say, are London Cocoa and New York Cocoa. They're slightly different contracts, by the way, but they tend to be highly correlated. I trade both of them. Kansas wheat, spring wheat, Chicago wheat, milling wheat in Europe, all of these are correlated to one another positively, obviously. Chicago corn and South African yellow maize, highly correlated markets. Heating oil and crude oil, highly correlated markets, usually, not all the time, right? So I have them all in my portfolio. And now if we just say I'm adding markets, which is true, I'm adding heating oil to crude oil and I'm adding Kansas wheat to spring wheat, say, I get a little bit of a diversification benefit from that, but also more often than not, a clustering of risk in the sense that if I have a position in one market, I'm very likely to also have a position in the other market, and they would essentially add up. Now, I do recognize that in for instance, with the cocoa markets that I've just mentioned, every once in a while they decouple. They have decoupled, by the way, this summer with the cocoa market in London being completely or behaving completely different than the cocoa market in New York. So there is a benefit for trading both of them, and but the way I do it is, I don't strictly add them together. I have a correlation adjustment so that I could trade both markets, but I would trade both of them a little bit smaller than a standard risk size or unit size, so to say. And this logic applies to my entire market universe. And as I move along and add all of these markets, and I'm trying to find as many as I can. Yesterday, Jerry and we chatted, I think, about the high yield index, which is a iTraxx or CDX high yield. There's a futures contract on that. A couple of years ago, I actually traded that at FC Stowe, and it wasn't very liquid back then, but I gave it a go. It was relatively easy to get in, but tough to get out, so I'm not currently trading that. But Like if that market were more liquid, if weather derivatives were more liquid, I would love to add them. Obviously, a function of assets under management. How much can I really deploy? But I would absolutely add them to the portfolio, given that they have outlier potential. They will behave different than the other things that I have in the portfolio. They have their own character, so to say. But I would apply the logic that I've just mentioned across my portfolio, so that the sizing works. And the more markets I have, the more diversification I get in the portfolio, the lower the overall risk and volatility is going to be. And that means that I can, slightly increase, maybe ever so slightly, the position sizes and the risk that I'm taking with every single trade, given the correlation benefit that I have. And therefore, I absolutely disagree with the notion that the result of what it is that we're doing is a lower return. It is not. It is not a lower raw return. We can make the same or even more money by doing this, and at the same time reduce our drawdowns. So that is a good thing, and that to me is very clear and logical. That the more things you add to a market or to a portfolio that are really uncorrelated and independent of one another, the better the end result is going to be. That is, yeah, it's very logical to me, but apparently not to everyone.
Hi, Cherry. Can I ask you a question? I know this, we only talk about trend following most of the time, but do you think that using the difference between open equity and closed equity to size positions would be beneficial for other kind of investment styles, or is something that you never thought about?
Good question. Yeah, I mean, I think the whole strategy here. See, back in the turtle days, we were taught some of these principles, and then I had to evolve the principles a little bit more because we were trading so short term that the difference between open equity, total equity, closed equity, these numbers were super small. It didn't really matter. But then the longer term you trade, then these things started, holding a trade, average trade for a year, which is what we do. You have to kind of figure this stuff out. And I particularly was happy that I figured out this cutback rule. So if you do go in and start cutting back, what is a good rule for putting positions back on, and how are you going to change your positions later? But I guess the fundamental principle that we were kind of taught is that even with these, assuming these short-term systems that we were traded back then, was this whole idea of the pros and cons of compounding, and continuing to change your trade level frequently was a violation of maybe trying to be treating all the trades the same for a while. So the rule was we would keep the trade level the same for the whole year. So even if we were up, sometimes we'd be up 200% in June, and so we would still be trading that $1 million base level that we had January the 2nd. And then the whole idea of this constant bet size being, but if you keep changing the AUM, the trade level number, then you don't have a constant bet size for very long. The algorithm doesn't change. You just input it. You just keep inputting a new trade level. So your trades in the last part of the year are bigger than the first part of the year, and so it's kind of could play havoc with your edge. You would have overall made 200 ATRs for the year, but you lost money because the trades you put on at the end of the year were bigger than the ones at the beginning of the year. So I think it's just the possibility that you can get this compounding, but sometimes it can really work against you. So yeah, I think keeping your trade level kind of constant and realizing that if you have these open profits, regardless if you've got the open profits through trend following or anything else, they can quickly evaporate and go away. And I think it's just a little bit safer to trade a little bit larger unit size to make up for this somewhat artificial reduction in your trade level. Although it's the proper thing to do, it doesn't make sense to a lot of people. But yeah, you have to make it up. If you don't, you have to trade a little bit larger. And so once again, you're back to this one thing that's one of the most important things. It's in the top 5, if not number 1, for systematic trend following, is trying your best to handle each market the same way as long as possible, all the time if possible, and not make too many changes. So you can constantly bet over and over the same way, same entry, same exit, same stop loss, same quantity as best you can.
I do agree with that. I think this is the right thing to do, not only in our line of business where we work with futures contracts, but I would say it is true for essentially any trading strategy out there. If you're changing your trade level all the time, your open trade based on open trade equity or NAV or any of that, it is essentially adding a source of noise to your system, because your system, your position sizing would then react and become a function of the daily P&L or the P&L over time, a performance of your system, which is noisy, as we know, right? Or thought about differently, it's almost like it is like trading your equity curve. The better you do on any given day, the larger your next position is going to be, and vice versa. So I've never had any good experiences, nor do I know anybody that has good experiences trading their equity curve. It's like, following the trend use a trend following method on the trend followers. Well, I don't know. I don't think that is a good way of going about the thing. And I agree with Jerry that also in terms of trade statistics, like, analyzing your results, it is much better to stick to a trade level, a notional trade level for a period of time, a longer period of time. That is important, not just a month, but, say a year, right? And then, of course, if you have inflows or very, very strong performance at the end of this year, okay, then decide to change your trade level, but make that change and then stick with it again for a long period of time. Then change it, stick with it again for a long period of time, and so on. That, I think, is a less noisy trading process, and it will. The result is going to be essentially what you want. You take the edge that your system has. You exploit that in a cleaner way, I think.
I just wanted to make one quick comment, and that is, I get a fair amount of questions on direct messages, and it's always fun. And I was really proud of this one response I had, which may not be that great. I think that's inversely correlated. However strong you feel about your latest little quip that you put out there, it's probably not as good as you think it is. But anyway, someone was asking me about trend following the trend followers. And so this is something that comes up a lot, and you'd like to put this thing to bed. Although things never get put to bed. Oh my God, never, zero, get put to bed. But anyways, in my little universe, my little world, I wanted to put this to bed. And I was thinking of what can I say about trend following the CTAs who are trend following. And so I wrote back, do you think it's a good idea to trend follow the blackjack dealer? He said no. What do you think?
Well, I think it's funny. Yeah, exactly. Trend follow the roulette wheel or the blackjack dealer and see what that does. I bet you the outcome isn't going to be all too positive. It's one of the reasons why, like, just repeating, it is just not worth it. You're essentially making your entire trading process more noisier, and I'd rather avoid that and stick to a trade level. That's it.
Trend following the blackjack dealer is tough because liquidity is so small.
Trend following something that is always has an edge on every single trade, on every single hand, you quickly realize that I should be long that all the time. You want to, he has an
Right.
edge. He has an edge every single time. And so do we. Every trade, we have an edge. And trading more markets is like, instead of sitting down at one blackjack table and playing as many hands as you can, you clone yourself and you play every blackjack table at the casino, every blackjack table and all the casinos in Las Vegas at the same time. That's diversification. You're taking that edge, splitting it up into many, many different trials. And not only are you trading 300 markets, but you're trading, and this is getting back to what Moritz was saying a few weeks ago or last week, and that is, theoretically, if you traded millions of markets, because you had this edge, your winning days and months might start approaching 100%. Certainly the number of years, every year would be a winner, because as long as this edge maintained itself. So that's really the secret. That's really the holy grail. And we ignore all the benefits of the other benefits of diversification, which is smoothness and sharp. But we need to hang our hat on consistency of returns. That's what trend following. That's what long-term trend following does. The longer term you can trade, the more drawdowns you're subjecting yourself to. Ironically, the higher the likelihood that you're going to have winning periods.
Jerry, I think that trend following a blackjack dealer will be like reducing the sample size of being a blackjack dealer, right?
That's right. I mean, and I remember there's been so much analysis, because this one question is, another way of posing this question would be, when should you invest in CTAs? And the question, should you wait for drawdowns? Should you wait for winning periods? Just do it randomly all the time. And I think whenever you have a positive edge, it's always a good time to invest. And we have run analysis on this every which way. Using Winton's track record, we ran all this analysis. And the conclusion was there is no predictability on when you should invest, because it's not better to invest during drawdowns, because the problem is you'll miss getting in. It won't be a drawdown. I've had periods like this where we were up 20% in the year. That one year, 90, forgot the year, but it's in the 90s, where we made 65%. I remember going into meetings and saying, "Oh, we're up 20%. It's the spring. Wait till we have a drawdown," and we never had one. So that's kind of the problem. You have a positive system. It has nothing to do with trend following per se. You have a positive system where every time you bet you're going to win, then you need to make minimal bets, and people need to invest as soon as they can, all of it as soon as they can, because you're just the odds are against you waiting. When the odds are against you, you need to bet it all and walk away. But the longer you can play in trend following, from a CTA's point of view, managing the money, you want to trade small, bet small, extend your lifespan in the markets, because eventually you'll end up winning.
So the longer I've been spending time with you, Jerry, and with all the guys here, guys and girls, where are the girls? The more convinced I am by pure experience and evidence that trend following is a more superior approach. There's a joke about all the systems are bad. We're just like the least bad of all of them. But it's probably not fair to trend follower to say that. I have a little list of topics for today, and isn't it funny that one of them was about trend following the trend follower? You can do that. It's just, you're going to wait so long to get results. Why wait? Life is short enough. So I've started to, and I know, Jerry, you can't talk about products, but I can, because I love the new ETF. The new ETF, TFPN, trend following plus nothing. It's about $25. It's got a wide bid ask, but I pop it in and I get filled, and I do it twice a day. And I'm not dollar cost averaging because it's always flat for me, but I want to position twice a day. I want to add to my positions. And it's almost the only thing that makes sense in my current investing schema. Because I have other programs of other styles and things. I have, covered call writing, and I have SPY option guessing, and those are fun little bets. But the thing I love is all the other bets I have halted at this point because trend following makes a lot more sense and dollars. Thanks.
Josh, I heard someone talking about weeding the garden the other day, like you do. It was Art Holly from that
Beautiful.
podcast we had this week, and it was a good podcast. I think you'd get a lot out of it, Josh. He long shorts equities, and I'd be interested to hear what Jerry's thoughts are about Art's podcast.
Well, I definitely think that Art had a lot of good stuff to say. It wasn't all of this, everything I couldn't agree with everything, but I definitely think that it's a great podcast. And I would say that having listened to it, I would definitely say that Art, in my opinion, and I know Art, and we've spoken on the phone and in person. We've had dinner together. He probably has made it his mission, one of his missions in life, to learn as much about the turtles as he possibly can. I don't know of anyone. Certainly, there's been no podcast I've ever seen where anyone talked a non-turtle talked more like a turtle than Art. And so I think that's a good thing that he's smart to do that, because there's a lot of great Richard Dennis and Bill Eckhart, extremely smart people, and he has met a lot of the turtles and he learned a lot from them. And I think his trading and his philosophy is very similar. But he sounded like Rich a lot, and then he started sounding like me a lot. But it wasn't all perfect, of course. But yeah, it was a really good podcast, and that algorithmic advantage is really good. I really enjoy listening to you guys and Simon, and hopefully I'll get to meet him. He's very good. You guys both are really great, and interviewing these traders is a really good idea. Following up, asking them pointed questions. It's really, really a good podcast, and I really am hugely in favor. I mean, so much better to have a video. I've encouraged my friends, hey, dude, you got to do a video version of this. But yeah, from day one, you guys did that video. I don't know. To me, it just makes it a lot more fun when I'm on my treadmill listening to these podcasts. Maybe Alp and I will get on like the treadmills downstairs here, and we'll put in a podcast and we'll listen, and we'll get in a pretty good workout.
Well, I love your videos with Mike Melissino, because I love it when the eyebrows raise and you go at each other. I do enjoy that. And yeah, I get a lot out of your podcast with Mike, and they're great fun.
I'm really very happy every time when I see that there is a new video with Mike Melissino and Jerry. I'm really very happy. I understand that I will have a lot of fun looking this with Jerry's birds, really wonderful birds. Two birds, as I have mentioned, not one, two birds. So it's very wonderful. Yes, very good idea. And I think we need popularization, more maybe cult. And Jerry said that in the previous episode with Mike, more cult in our trend following. So these videos can help with this, because buy and hold guys have films, cartoons, books, so on and so forth, and we have nothing in this, and it will be very good to have something maybe similar to mass media in our space, in our trend following cult attack sessions, and it will be our trend following will be more popular because I have said before many times that our trend following models look much better than a lot of very popular models like, for example, SP500 passive phones. Our trend following models looks much better. People simply don't know about our models, don't know our philosophy. I think this is a problem.
Yeah, Mike is fun. He and I have a good time together. He is my good friend, and we play fantasy hockey against each other. And I pull out my spreadsheets and try to, during the draft and during the season, and he does a little bit of both. He's like fundamental and technical. You know me, I'm more fun. I'm more technical, more spreadsheet oriented in choosing the players. And then I doubled down this year. Hopefully, he's not listening, but what I did, data of the different players, I let's just say I went longer term. So we have some guys in the hockey league that are day traders. They're hourly bars like Alp. So if a player has two good games in a row, they drop someone and pick him up. And then if he has two bad games in a row, they drop him and pick up someone else. So I decided to not only, so obviously the past few years I've been a lot longer term than that. I need more evidence to draft a player or keep a player, get rid of a player. I decided to double my look back in the players. And so far, I'm pretty happy with my results this year. But yeah, trend following everything all the time. But I have no idea what Josh is talking about, this ETF thing. No idea. Sorry, Josh.
Okay, sorry, dear.
Hey guys, so hope everybody's doing well. Yeah, I had some comments on the. It's an interesting question whether you should be trend following the trend followers or trend following a blackjack dealer or a roulette table. And I could be wrong, but I'm smelling a paradox here, and I try to generalize where I think why we have this paradox and where this is leading. So I'll first tell you the conclusion, and then I'll tell you how I came to it. So basically, the conclusion is from the answer probably. So as you guys concluded, you shouldn't be trend following the blackjack dealer, shouldn't be trend following the roulette table, just like you shouldn't be trend following a trend follower, or you shouldn't be trend following something that has a proven permanent statistical edge. And therein lies the problem and the paradox. Of course, you should buy and hold and not trade something that has a permanent statistical edge. If you're sure that you have the Holy Grail, if you're sure that you have something that has a permanent and robust statistical edge, by all means, anything you do on top of just buying and holding it, it's probably going to ruin performance. Just like Jerry said, doing the backtest on Winton and doing the... So when you look at the successful trend followers in the past, they are like blackjack tables, they're like successful casinos, they're like roulette tables, and they're trend followers. Anything that you try to do to those equity curves, if you try to trend follow them in order to so-called improve performance, it's probably not going to work. But this is the question. And so now we go to, but then while we say this and we conclude this, we're also saying that nobody should be buying and holding stocks. Well, if you look at a stock, if you look at a company, the owners, the managers, the guys who are in this company, they too are convinced that they have a permanent edge over something. that they have discovered something. They are believers in the company. They wake up in the morning, they go to bed, they analyze their customers, their competition, and everything, and what they're doing, and they're creating an equity curve from their profits. So, for any true believer in what they're doing, they probably think that they have the best thing on this planet in terms of statistical edge, in terms of its size, how big it is, and in terms of its robustness, in terms of how permanent it's going to be. Otherwise, they wouldn't invest their livelihood and life and such attention to it, which is exactly the same what we're doing. So we're investing our capital, our time, our belief, our trust, our consciousness into something that we think offers the best statistical edge, not only in terms of its size, but in terms of its robustness and permanency. We are concluding, from our analysis of the world, on reality, of markets, of stocks, of bonds, of businesses, of hot dog stands, casinos, or whatever, we are here in this space. We have concluded, listen, this is the best place. This is the best way for me to allocate my resources, my intelligence, my attention, and my capital so that I can be successful and I can be profitable. So it only makes sense that anybody who makes this decision about something, anybody who has committed their life or their livelihood or their time and their capital, they're going to think this is the best thing. This is the best thing that I can do and that I can do, and I will do it. And I, of course, would not want to trend follow it. I would want to buy and hold it. Just like we wouldn't want to trend follow our equity curves and our strategies, or TFPN, which Jerry doesn't know what it is, because for unknown people, TFPN is just a stock that they can or may not add to their portfolio. Let's say they didn't know what TFPN was doing. It's a company. It could be a casino. It could be a hot dog stand. It could be a wheat maker or a bread maker or whatever. It's just a business. It's a business that has found an edge and it's extracting an edge. And in that sense, if you're blind to the universe of stocks, which are all proxies for businesses with edges, and if the argument is if there is an edge there, then why trend follow it? Why not just buy and hold it? The answer to the question is that nobody, including no one, not one of us here in this space, nobody knows for sure that their statistical edge is permanent. And that's why you should trend follow everything. And we trend follow our strategies too. We do. If you then don't trend follow them with a certain system or a systematic, we all have an uncle point at which point we will say, you know what, this sucks. I can't stand this anymore. I'm out. And that's trend following. Now, whether you're going to be out with a 20% drawdown, 40% drawdown, or 80% drawdown, you will be out. You are trend following. You're out because the losses are too big. What do you guys think?
Well, I don't really agree with all of that, but now the problem with that is that we have a system, we have a back test performance track record of a certain strategy, and I think that a stock is different from a business. So I do think that they probably are usually can be trusted. You know, they put money into their companies because they know that they are making money and they have a good product or service. But the stock doesn't always work out that way. 4% of the stocks make all the money on a buy and hold basis. So they're wrong in thinking the vast majority are wrong, probably. Or maybe they get out when they think things are going to turn around. They buy when they think things are good. They get out when things are bad. I don't really think it's that comparable, someone investing in the stock. But I do think the first step of any investment, of course, is does this person have an edge? And so if you don't think they have an edge, you're not even thinking about trend following it. I don't think they have an edge, but I'll trend follow it. I don't know about that. I wouldn't recommend that. So I think it's a no-go right at the question number one. Do they have an edge? If so, I won't try to I won't try to trend follow it. But and I don't think buying something and then like a CTA or an investment, and then having understanding that you think this person does have an edge. They have demonstrated an edge with the performance, with a live track record, and then at some point realizing that the edge is not what you wanted it to be, and then making a second decision to get out of that is similar to trend following. It's something else. I mean, it's trend following does have this idea of you get in and then you take a small loss, but there's a lot more to trend following. So I don't think that's that very comparable either.
I fully agree with Jerry, and I think we have strong mathematical approach, logical approach, philosophical approach, and the guys who only trade the stock, they don't have this. They don't have systematic, robust rules. So there is a room for discretion here. I think that it's not the same as a business side. So really, to buy stocks is different than to operate a business. I think yes, and it's not trading because there is no such. We have our enter rules, exit rules, money management rules. We have diversification. So I think that we have strong approach, and if you operate with stocks only in a such way that we will discuss, I think it's not good. It's weak. It's my opinion that it's weak approach. Not enough factors. No math here. No math, at least. So no system. No robustness.
So you think the managers that Warren Buffett picks for his portfolio or companies that he's buying don't have diversification, don't have math, don't have trades, and don't have an edge, and don't have a track record?
I see my own opinion based on my own experience and own experience of people from of Jerry, of Maritz, of Richard. So I don't know all about Warren Buffett. I can only say that I don't know his methodology, and I don't want to know this even because I'm very focused on and concentrated on my methodology. I even go to forest to think about my methodology. Yes, because nothing bothers me there. So, and I don't think that I can discuss in a such way because Warren Buffett is a very big example. And yes, very big example, successful example, but I know nothing about his methodology. And what I know about this don't look attractive for me. Don't look attractive. What I know. Maybe there is something that I don't know, but what I know, I don't like what I know about this. Here's my point.
I would sort of guess that, I don't know. I mean, I'm just trying to think. Is there no stocks out there that that can't be improved by trend following them? And sometimes what sends these stocks a lot lower is beyond the control of these super smart people who definitely have an edge. Every stock, I mean, almost every stock I looked at yesterday was down yesterday. And some of these companies are in big downtrends and they may have ways to go. And I certainly wouldn't rule out the possibility that they're all run by really, really smart people. It's just that it's beyond their control now. And I really think that all markets, including these, I tweeted this week, your precious little stocks, even your precious little stocks can benefit from some trend following because these people can't stop. I can get in and out and get out with a stop loss and then flip it around and then go short. And these are all positive expectation trades. And they just don't have that ability to be that nimble. And these are super smart people. They have an edge, and their edge is going to play out over time. But I can improve what they're doing by overlaying the stocks, the trend following. I tweeted this thing this week, and this guy kind of called me out on it on Twitter. Long stocks and bonds plus managed futures is missing the equity trend following piece that is necessary to protect the portfolio. In other words, passive long stocks and bonds plus managed futures, you're not really trend following those stocks and bonds. That piece of it, that piece would improve if you trend follow those as well. So every market, even the precious stocks, need a trailing stop, a stop loss for the ultimate protection. And he writes back, shouldn't the stocks in the managed futures component accomplish that? Yeah, I mean, that's true. If you're trading, well, he's basically, the managed futures component is going to be stock indices. So trend following those stock indices is not going to be that part of the portfolio in the trend following portfolio is not going to perform as well if you don't by just trading those indices. You long and short stocks is going to be better. Trend following the individual ones, I think, should be better. When equity trend is down, you will be short in your trend following. Okay, and long in your longs. So basically flat. Okay, that's the part I wanted to get to. So it's just kind of like, when you talk about currencies, commodities, and interest rates, everyone knows exactly what the deal is, but everyone forgets everything they know when you talk about stock trend following. It's the same thing, people. Come on, same thing. You got this group of stocks that you randomly put together based only on correlations and diversification. And you start taking these trades, long and short, and irrespective of the stock trend. What is this stock equity trend? It's this overarching indicator that someone must have that has a green and a red light that flashes in the trading room that says, now you can buy stocks. Now the market is up. Now the market is down. No. I'm long and short currencies. The dollar versus the euro and that stupid dollar index, which is heavily weighted to the euro, that's kind of in an uptrend. But I'm short the dollar against some currencies. I'm long and short some commodities. I'm mostly 100% short interest rates because they're all in a downtrend, most of them in a downtrend. I've got some ETFs that I'm long, let's say. And so the stocks are I guess they're kind of in, what is the stock market? Is it in this uptrend or is it in a downtrend? I don't really know. I don't really care. I don't look at something, a filter that's telling me what my individual stock positions to do. I just trend follow them. So I'm long a bunch, I'm short a bunch, and they're all positive expectation trades. They're not all going to make money during this particular move. They're going to be heavily influenced if we have a massive rally or sell-off in the S&P. But yeah, this is, I don't know about this equity trend. And why can't I just be long some? And I've got some outliers on the long side. I've got some outliers on the short side. They're both, and then I've got a bunch of not doing anything, and I've got a bunch of flats. But I don't really understand this. I've got to take this trend following and make sure that it jives with how people look at traditional long only investing. No, I don't. I won't. You look at what I do and try to emulate what I do. That's better for everybody. And that is treating these markets individually like you do all the other markets and going with the trends. And you're going to end up with, sometimes I'll end up with I'll have this incredibly diversified portfolio of stocks and I'll be 100% long. And then other times I'll be 100% short. And then everything in between, whatever you can dream up, it's going to happen. It can happen. It will happen. And it may have never happened before. So I don't know what's going to occur. I don't really pay much attention to the overall market. Like I don't pay attention to the dollar index or the Goldman Sachs commodity index and maybe a bond index. But yeah, treat all these markets individually, separately. And if you have some longs during a period where everything else in the sector is going down, be happy. That's what you're after, because that could be a potential outlier.
Simple is too complex for most people.
Sometimes simple goes against conventional wisdom and conventional thinking. Everybody wants to be unconventional. Everybody wants to be contrarian. Oh, well, not if you're going against what I know to be true. There's another thing I bookmark I wanted to mention that came from Absolute, and it was, oh yeah, this was another good point. There was some chart that was choppy, and he says, "Why waste time on such an ugly chart? That stock is down versus 16 years ago." And I'm like, yeah, that really reminded me of this whole thing where the difference between trend following and buy and hold, where they do these studies and they say, well, 4% of the stocks make all the money on a buy and hold. So you've got to own the entire market to get these outliers. You can't predict which stocks are going to be that 4%. And that's one way of doing it. And then, of course, some of us are no, that proves that you need to trend follow. But even in this ugly chart, that is down versus 16 years ago. I forgot which chart it was that Absolute was talking about. It is ugly, but that's sort of how trend following works. Is that probably one of the greatest trend following trades of all time was long Enron and then short Enron, and it went to zero. And so that's pretty ugly. But in between these 16 years or any amount of years of ugly charts, you can still have these trends. And that's what trend following can get onto. And that's what makes it so amazing, that it doesn't matter if it's ugly for 16 years, that in between, it's what's in between. It's was there any charts? I mean, there can be the opposite too, where you have a beautiful chart, like Apple or Google, that just keeps going up for many, many years. And my guess is when you get into charts in markets like that, where it's just been so beautiful uptrend and all the massive drawdowns, if you got out, you would have totally regretted it. My guess is it would be very difficult for trend following to beat that. Trend following always is going to underperform in these big, huge bull markets, because you should never get out. You should just hold on. In hindsight, it's a mistake to get out of the S&P sometimes, even though we get out and we go short, and then we have to get right back in at the highs again. So trend following is going to underperform that. And the way that it makes it up is through its getting out and not participating in being long in big down moves, and then leveraging to some degree as well. You have to leverage up to catch up. Sometimes you don't always get these lost decades in stocks like we did in 2008.
Yeah. So along the same argument that I was trying to make, the way when you say nice charts or like businesses with healthy statistical edge or nice equity curves, they're always gonna buy and holding them always going to outperform trend following. But I think that's why trend following is good. Even if trend following a nice chart underperforms buying and holding it, I think at least the way I approach it is that I would still find a way to trend follow it, because let's conclude, because of our psychology and because of what can happen and because of the unknown future, we trend follow everything. Even the buy and holders trend follow in a certain way, just not systematically. But they do have a stop loss. It's not systematic, it's not small, and it's big, and they're going to hurt them a lot when it happens. So buy and hold may appear on nice charts, on nice, beautiful, like the 60-40 chart for the last 50 years. It's a beautiful chart. You should have just buy and hold it. All these advisors are advising, don't chicken out, just hold on. Look at this beautiful chart for 50 years. Don't do it. If you trend follow this, you're going to underperform. But the counter argument to that is, yes, I will consciously underperform, but I will still trend following it, because the price that I'm paying in a subpar performance versus buy and holding is the insurance which will pay off when that 50-year beautiful chart stop being beautiful. And I don't know when that's going to happen. And it's just going to be a one drawdown, a big drawdown. So all the 10 drawdowns before, I shouldn't have sold. Woohoo! Yes, great. You're smart. You never should have sold it. You should have held on. 10 drawdowns. If you sold in some of them as a trend follower, you would have hurt performance. But then one big one, which is like a 60-70% drawdown. So if you don't sell on a 30% drawdown, hold. If you don't sell on a 40, you hold. If you don't sell on a 50, you hold, because the back 50-year so-called backtest or equity curve of 60-40 tells you that you shouldn't have. Then what is the drawdown at which you will sell? Like if it goes to 60, will you sell? Well, no. Advisors are still going to say, don't sell, don't sell. It's coming back. Then it goes to 70. Are you going to sell? No, don't. Well, at 80, everybody's going to sell. Like the 1929 crisis. And it happens once every 100 years. And that's when everybody's going to sell. And you're going to totally destroy 20 or 30-year performance with that drawdown. And then compare trend following with buy and holding. So the argument is that trend following, we always trend follow. The beauty of what we're doing is that we're trend following systematically. And every equity curve, every business, every endeavor, everything can be improved by trend following. But it may not be visible that it's improving because look, I'm backtesting 20 years, a nice equity curve like Winton. If I trend follow it, it's going to underperform. Yeah, it's going to underperform. But when Winton goes down 80% because of something like long-term capital, you would have been thankful that you're trend following it. So that's my argument.
I agree. It's kind of like in hindsight, you know exactly what to do. But since you don't have the hindsight of what's going to work in the future, then you're better off with these mechanical rules. So I agree with that. I remember some of my mentors saying, for more security and less potential drawdown, I'll take less money. So even if trend following kind of underperforms S&P or anything, it's doing it in kind of a way that you may enjoy life never having to make a big insurance claim on your property or in your portfolio, but it doesn't mean that risk wasn't there. And by having that insurance policy of trend following, and you didn't make as much as your friends, okay, but it was still the proper thing to do. But it's you don't know what to do in the future, and so you do the best you can with the tools you have, and these are great tools. This trend following with lots and lots of markets, small bet size.
Yes, I like that fact that we, as Neil said, that we always have a plan, always, no matter what is going on, in maybe almost all circumstances, and we have a plan what to do. And it's a very, very big strength of what we're doing of our system, because we're doing consistent things with the good risk management, with the diversification. It's a very beautiful thing, in fact.
But you also have to have a plan for what to do when the plan stops working. So you also have to have a meta plan. So do you have a stop loss or a strategy or a systematic way of handling when what you believe 100% to be the holy grail stops being that? When you become hit in the head, when the market convinces you that what you thought was a sure thing, that your statistical edge of certain win ratio or certain statistics stops being that for 5 years, for 10 years. No, it's not there anymore. Oh, is it temporary or is it not? Is it still a holy grail or is it not? Just like every buy and holder, you're buying and holding your strategy, your equity curve, just like a stock. You're buying and holding it. But the argument should be on a meta level. Should you be buying and holding anything, or should you always question everything? And I think what Mike Harris also was trying to allude to. So basically, yeah, you are religious, you're following this and whatever, you believe it's the Holy Grail, but nothing basically is. And I agree with him about that. We can only relatively speak in relative terms, what is more likely to be robust versus what else is out there, what you are aware of or what you know. But I don't think, just like my absolute name is, I don't think there are absolute I don't think there's anything absolute in terms of, okay, this is it. This is going to be it forever and it's permanent. Nothing is. And you have to have a plan for what happens when that happens. Like, what's your uncle point? When do you get out?
Yeah, I wouldn't really think in those terms of a sure thing or something that you think is always going to work. I don't even think in those terms. So that was part of your first sentence. And I was like, nope, can't agree with that. But I think that for me, we're always repeating ourselves on some of these things we believe in and the characteristics of the strategy. And of course, one of them is we never in the back test have we ever seen the open trade equity drawdown exceeded not exceed the closed trade equity drawdown. So yeah, it's little things like that you've never seen in the back test that if you start seeing have and you may want to wonder what's going on. And I think if you have these big trends, like you see them and you're not able to capture them with your specific signals because they're too choppy and you're not trading long-term enough. But then as soon as you do get trends that are not too choppy, you trade because you're trading long-term enough. Then if they reverse and you don't take much profit out of the market, then those two factors, you're like, oh, this is hitting at the core of how the systems are designed, and this has worked. So I really need to question this. So I think if you have your system kind of set up and philosophically how it's supposed to work, and it's pretty easy to evaluate it and come to the conclusion that maybe it's not working. I think with proper trend following set up the way I would set it up, but your worst case scenario should be, it's been many years since I've made any money. It's not like I'm losing a great deal. It's just I haven't made very much in such a long period. And the problem with that, of course, is that we had a period like that, not where every year was negative. We had some good years in that lost decade, and then we had some bad or flat years. And then all of a sudden, as soon as you get disappointed and pessimistic, 20, 21, 22 come along, and like trend following is reborn, and we should never have questioned it. So yeah, I think these are all good things to think about, and I agree.
Yes, interesting topic, but I have my own methodology that I have invented. I look in the window and I see mountains there, and I began to think. Let's imagine that it's a Brent chart or cotton chart or something, or USD chart, and let's apply trend following rule to the mountains, to the image of the mountains. And it works. If it would not be an image of the mountains, it would be a chart, it would be working. I mean that we use very universal rules, and I said this many times, very universal. And we see the same laws everywhere. So it gives me a 100% sureness, confident that trend following is perfect. Yes, and I think, of course, maybe a few years it can be without profit, but if you have a good risk management, if you have a good diversification, it's very, very, it's not, I can't imagine how account can be ruined, because even in nature, I see the same laws, the same everywhere.
Another thing I liked this week was this idea of talking about forecasting. Yeah, trend followers forecast, predict, and I think this is a good topic. It's kind of fun and funny, and so this one article I read said, trend followers make market forecasts just like everyone else. The use of the term prediction aims to put on everyone else the stigma of a leaf reader and distance trend following from their practice. All traders in all time frames, when they place a trade explicitly or implicitly, make forecasts. Otherwise, they should stay flat. And I said, for me, being flat is a forecast, just as much as being long or short. And I think what's interesting about this is that I didn't really understand, and I do kind of get it more now, that it sounds like trend followers are saying, oh, well, we're amazing and awesome compared to you other people who predict. Okay, so that, I didn't really mean it that way, but so that I don't think that's true, that you shouldn't feel superior because you say you don't predict. Although I don't think that technically I can agree with that, but it is sort of true, but in the sense that, but it does bring up a very good point to discuss, and that is, the difference is, I think, that that for trend following, you have no right to think that all the math says you're not good at predicting because you have a 60% chance of losing. And so to some degree, I think when people hear about predicting, you can't sort of say, well, I think over the next, 5 years, this is going to occur. Like, what? Shut up. We're not talking about the next 5 years. We're like, do you think rates are going up or down? Now, dude. You can't put it off over time, no. And so I think that's what trend followers are not able to do. They're not able to make a good bet, prediction, or forecast on the next few trades. It's only going to work out. I'm only doing this because over the next 1,000 or 100 trades, I think I might make money. So I'm not even saying that rates are going to go higher, which is what most people kind of talk about when they talk about predicting today's rates, let's say. And we're not even saying that. We're saying, no, not today and not rates. We're saying over time, in all of these markets, currencies, commodities, stocks, and bonds, long and short, we'll make money. We do predict or forecast, which is not the perfect word to use. We're definitely betting money. But in the traditional way that people think about forecasting, we're totally incompetent at that. Go somewhere else for professional advice on what you should do next. Trend following it's totally bankrupt on how to handle these current trades. If you have to get them right, I know how to handle them in my system, and I know if I continue to handle them this way over time, that I will make money. But that's a kind of a certain way that I can torture the English language into saying, okay, we are kind of forecasting or predicting in some way, but not in the way that people expect traders to forecast. But I do think it's a fascinating subject.
I don't have much to comment. I don't have much to comment on that. So, yeah.
I'd just like to say that I view what we do as a process, not as a method of prediction. So when I think in terms of prediction, I'm thinking in terms of, historic patterns, acting on what's happened in the past based on historic patterns. That to me is a method of prediction. You're basing your assumptions based on what has happened in the past, a particular pattern, and the way prices responded to that pattern. And a prediction to me is the assumption that in the future, if that pattern is found, that there is a high probability that price will follow that same price action. So when I think of what we do, I say to myself, well, who knows where the next outlier comes from? No, none of us know where the next outlier comes from. But we do have a process that catches them. So to me, it's not about predicting or selecting which of the opportunities in the future you think are going to have the outliers. It's by applying a blanket universal principle of diversification across all liquid markets with a particular process that is designed to capitalize if those opportunities arise. But that to me, it's totally different to how I view predictive methodologies, which are there's nothing wrong with predictive methodologies. I think there are edges to be extracted from predictive methodologies, but it's certainly not in our lexicon where we're dealing with outliers, which are chaotic anomalies, which are inherently unpredictable. We don't know where the next one's coming from. So we've got to apply a process to extract that opportunity if it does occur. But we certainly never know where it's going to occur, when it's going to occur. But this process we do turns sort of like a statement of luck, being in the right place at the right time, into an actual process where we actually do benefit from being in the right place at the right time, simply because our process demands that particular setup to occur.
Yeah, I just actually I do have a comment on this, and I blanked out previously. I was doing something else, but uh, I mean, you guys know my stance on this. I think we don't separate. We're not different from any other quantitative predictors, and when we let's say when classical trend follower enters a trade, so they're saying I'm not predicting, I'm just reacting. Well, no. When you enter the trade on the breakout, you're predicting that given the setup that is happening that's required you to enter the trade, you're entering the trade now at this level at this time because a certain pattern is occurring, and this pattern in the past is proven in your backtest has provided 3-to-1 win to loss ratio and with 40% success rate. So you're predicting with 40% probability I'm about to make 3 times my stop loss. So, or something like that. So as I enter this trade, my predictor says with 40% chance, I will make 3 times the stop loss or something like that, or the average loss or the stop loss. So that's what you're predicting. And the backtest has said that because my backtest told me this is what the statistics is. Now, no predictor is you don't have to be 100% predictor to be a predictor. No predictor predicts something with 100% probability. So a classical trend follower predicts a certain outcome with 40% probability. So 40% chance I will make 3 times my stop loss. That's it. Or overall, over this whole set of my entries, given this exact same pattern, I expect a certain outcome as a set. And that's what all predictors do. Predictors make don't make errors, but predictors predict something and reality gives them something else. He's still a predictor. Predictor doesn't have to exactly predict the future for it to be called a predictor. Same thing with classical trend following. You don't have to exactly predict that you'll have 10 ATR or 20 ATR profit right now as you enter. You just predict with certain outcome for a set satisfying the entry pattern. And to me, that's a predictor.
Exactly. Yeah, I'm not against that. It just doesn't mean very much. I mean, to most people would say that's not much, and that's all. I mean, I don't think it's bringing out the dictionary to debate this is not nearly as much practical fun as just realizing that there are a little bit of difference between what CTAs mean or trend followers mean by predicting and what how other people. It's just different ways of predicting. Um, I listened to this.
A lot of emphasis as well, Jerry, is placed on this term expectancy, which I hold very little weight on, which has been bandied about tonight. In our world of the tails, I don't think there is such a concept of expectancy. It is such a nebulous term. If there was such a concept of expectancy and stability of expectancy, we'd be applying Kelly positioning criteria for our method, but that doesn't work out in the tails.
Yeah, I think this is just one of the nuances that Richard and I, don't see eye to eye on necessarily. And that is that it's okay to mention it again, I guess. And that is, and I understand where Richard is coming from. And I just, I'm not an expert in this idea. I could just say that other experts who are an expert more along with Richard than I am would say that including the tails in the calculation of expectancy is fine. So I think what Richard is kind of saying, and he can speak for himself, but to enhance the conversation, I would just say what I think he's saying, as he can correct me if I got it wrong, is that it's not proper to calculate your total profit by including all the trades. those and dividing it by the number of trades to get your expectation per trade. Those outliers are too weird. They're in a total class by themselves, and they cannot be put into the same bucket as all the small trades, winners and losers. And so, but others have said, by the mere fact that obviously that they are crazy, there are outliers, but because they were created with the same rules that produce the small trades that are not part of the outliers, the rules dictate that they can be put into the same bucket, all that profit that came from those 10 to 13% of the trades. Divide those by all the trades. That is your expectation per trade. And it is, you should feel, I do feel a little queasy that, and who wouldn't want life to be different? You know, I embrace life the way it is in the markets, but who wouldn't want it to be a little more different, where we could just, you know, have these trend following systems just crank out this consistent profit without having to deal with these big, huge outliers. That's just not how the world was created.
The way I view expectancy is the way I view Sharp. It's a statement that is effectively a marketing statement to me that is attempting to say, we've got stability of returns, we can forecast our expectancy, this is what you're going to get in the future. I don't view trend following, our particular approach, as that, because I see these significant regimes that might last 10 or 20 years where our expectancy might be low. Another 20, 30 years, our expectancy might be very high. It's all dependent on where and when those outliers strike. So to me, there is no stability in this term expectancy. And, you know, we might have, suffered over the last 20 years with fairly low expectancy, simply because of the market regime, QE, all of these sort of particular events. But then people would say, well, this is our expectancy, but there is no sort of stability of that term when, you know, for the next 20 years, if we have, major outliers occurring, major market dislocations, we might be doubling that expectancy over the next 20 years, 30 years. So I just don't think it's something, it's a bit like volatility smooth. It's a bit like if you get a smooth sharp or you get a smooth ascending equity curve, that's where you get stability of expectancy. But we've got lumpy returns, we've got positive skew, we've got big step ups in our equity curves. It's non-linear. I don't think the term expectancy carries much weight in our world whatsoever.
Yes, and I don't disagree with any of that. However, I would just add that this is why the same people who would say positive things about expectancy would always say you must use all the data. So as you build up these long-term back tests from the 60s, 70s, and now, so you use all this data, and your expectancy is what's in all of this historical data, and so it's not going to change very much. You know, if your expectation per trade is 2 ATR, 3 ATR, 4 ATR, the more you start adding on 2022, 2023, 24, 25 into the future, and it becomes less movable. It doesn't change very much. It would take way more to change. But now the expectation of next year or the next 1,000 or 100 trades, yeah, that's all over the board. But that's why, unfortunately, for CTAs, they should use all of that data. And if you start using, the more data you use, the more you start adding on, the less you're going to be able to change. It would just take too much to sort of even change your parameters very much. And that's why I'm a big advocate of using all the data from the 70s and 80s where there were no computers. This sounds crazy. Yeah, it sounds crazy, but I think I'd rather have more data than less. And I don't think recent data is better at giving us an indication of what's going to work any more so than data that's 50 years old.
But I think without expectancy, you have nothing. You can't say, if you have a strategy that has zero or negative expectancy for 50 years, and you're saying, but wait, this only means that there are huge outliers waiting just around the corner, maybe in 5, 10, or 50 more years. You just wait and then they'll come. and then the expectancy will be positive. So expectancy matters, and we
Well,
add
it
more
doesn't
markets.
necessarily absolute because we know that storms exist, we know cyclones exist, we know hurricanes exist. We build our houses, with that knowledge in mind. We're not building it based on an expectancy equation. We're building it based on our knowledge of how these markets, the mechanics of these systems work. I don't think you necessarily need to be guided by an expectancy equation. An expectancy equation is something to give to an investor to give them confidence that, oh yes, it's going to be delivering this over a period of time. But I think we're kidding ourselves if we give investors that message, because there is no guarantee of that. And I'm very sort of doubtful of our ability to deliver stability or consistent returns. But I do know that if these markets are incredibly volatile, if we do get into these situations of these massive trending environments, all we can say is we're going to do very well out of it. That's how I view it. I'm not viewing it sort of as an equation that we say is stable. I'm saying these markets are inherently unstable, and this is the approach you take to build your house in these unstable markets.
So you're saying if 10,000 trades in a backtest over 300 markets over 50 years in a backtest produce 3-to-1 win to loss ratio and 40% success, you're saying no, that's just for the last 50 years.
But you're saying we can suffer complete risk of ruin with trend following strategy. So you've got to agree with that statement.
Oh no, I say as long as the statistical edge exists, but in order to describe a statistical edge, you have to have expectancy. Without expectancy, there's no edge. How do you quantify your edge?
No, we can't use Gaussian statistics for what we're dealing with. So the expectancy equation is as we all know, is the percentage win by the magnitude of the win, less the percentage of the loss by the magnitude of the loss. That's all the expectancy equation is. It's a linear equation, for God's sake, and we're dealing with non-linear markets.
Okay, so throw away the linear equation. It's worthless.
Well, it's just a little marketing statement that someone came up with. This, hey, this is a good idea. Let's give investors the perception that we can sort of forecast out into the future what stable returns we can deliver with our particular process. And I think that's a bit of a furphy.
Nobody said anything about stability. You could have a Sharp of 0.4 and still have a statistical expectancy. I'm not saying you should have a Sharp of 4 or consistency is not, but didn't we agree that if we trade million markets with 100 strategies, which are variations of patterns and whatever, the more markets we add and the more liquidity and capacity allows us to trade, the smoother the equity curve becomes. And then your, how do you call those, jumps or whatever you call those, like non-linear things that are jumps on the equity curve disappear.
Yeah, but what's happening? We're distributing the outliers over the time series. The jumps are still there, and because they're being distributed. So in our non-linear world, it's the outliers that's doing all the lifting power. The random perturbations that are 80 to 80% of our trades are doing nothing. They're flatlining or they're giving us small drawdowns. So when you actually magnify that and you start distributing outliers over the entire return series, you see that it's actually the non-linear anomalies that are doing all the heavy lifting. So there is non-linear uplift occurring, even though you will visually see it as a smooth equity curve. Sharp is going to be penalizing positive volatility when we get these step-ups in our equity curve. So when we were talking about Sharp earlier, the major problem I've got with Sharp, as we all know, is that it penalises positive volatility. So when I look at Mulvaney, I see he's got a Sharp of 0.58, but I know that over the last 20 years, he's produced the best returns out of any of those CTAs with a 0.58 Sharp. When you look at his equity curve, yes, it is volatile, but what you'll see in his equity curve is it's the positive volatility that's doing all of the uplifting. It's the outliers and the step-ups that's doing all of the uplifting, which is being penalised by that Sharp ratio. And if you say to Mulvaney, what's your expectancy, Mulvaney? He's going to come back at you and say, I've got no freaking idea because I've got a bloody volatile equity curve, which we do understand it's a volatile equity curve, but he's producing these stellar returns without having this stability of expectancy.
Well, then what are returns? Why are you averaging returns then? Like a CAGR or average returns, or saying he's the best? How is he the best? Are you averaging something? Are you making it linear? Like 14% a year, 15% a year?
Why don't I say Man's the best? Is that what you're saying? Man AHL, why aren't they the best when they've got better risk-adjusted returns than Mulvaney? Well, they're not operating at his leverage. And when you look at the total wealth over that 20-year period, Mulvaney has doubled or tripled Man's result. Yes, Man has produced smoother returns and they've got better risk-adjusted returns, but in terms of actual wealth, the investors sitting with Mulvaney are going to be the ones slapping him on the back saying, well done, you've done a great job, you've got given me the biggest wealth over that long-term period.
The reason that Mulvaney has this is correct is because Sharpe was not an accurate estimate for actual risk. That's the problem. It doesn't translate. It's this pretend PhD, MBA, Excel number from a spreadsheet that doesn't necessarily, for Mulvaney and for classic trend following, doesn't translate into anything that's tangible. In fact, other people have made these arguments that it's the exact opposite. A high Sharpe means that you're probably going to blow up, and that we've experienced that before with managers who had those high Sharpes. And in some ways, theoretical trading ideas would they take small profits and let losses run, do the same thing.
So then Mike Harris was right. If Mulvaney expands from 45 to 300 markets like Jerry, he will just dilute his returns and increase his Sharpe.
Why are you saying that?
I claim that if Mulvaney expands from 45 to 300 markets with the exact same system, he will have a much better performance. He can still make 16, maybe even 20% a year with a 0.7 Sharpe or 0.6. And that's a superior performance.
And what he's probably finding he's doing is he's distributing those outliers over the time series better than how he's currently presenting it, which is fairly lumpy. But this distribution of outliers is distributing non-linear outliers over the time series. It's not distributing the linear elements of the distribution. It's distributing the non-linear elements of the distribution. That's what's giving the lift.
Yeah, but I don't see the lifts. If you see a nice equity curve, 0.8, 0.9, or one Sharpe equity curve, it's a nice equity curve. It's just the trades that were produced by the strategy. There's no lift there. There's no jumps like it's in Mulvaney's chart, like jump and then rest for 6-7 years, like a drawdown.
The difference is, if you look at the risk-free rate, that's the smoothest equity curve of all, the risk-free rate, but that's got absolutely no lifting power. It's tepid. It's incredibly smooth, though. So that's the argument. Those with Sharpe are diluting their lifting power with higher Sharpe because they're compromising the outliers by taking profits off the table.
You can trade 300 markets like Jerry does with classical trend following. You don't have to cut your profits.
I'm not arguing that. I'm agreeing with you there. You can, and that's what we're doing.
So then why not trade 45 markets like Mulvaney?
Because as you've said, and I agree with, by trading more markets, you are distributing more outliers over your time series. So you are getting a lifting power geometrically over the entire time series, as opposed to being discretely clustered in lumps across the time series where you get fairly volatile periods. You get a better chance of having a better lifting power all the way over your geometric curve.
Okay, so you're getting lifting power almost all the time, which means a smoother equity curve, higher Sharpe ratio, higher drawdown ratio, which is all good. Which are all great things.
Getting a smoother equity. But the smoother equity curve is coming from the non-linear anomalies. That's what we're saying. It's coming from the outliers. It's not coming from the linear attributes or the linear properties of the system. So there's many different forms of Sharpe. There's a smooth line that can be created with the risk-free rate. There's a smooth line that can be created by someone who smooths their equity curve through dynamic position sizing and volatility adjusting. And then there's a smooth equity curve that can be achieved by the outlier hunters by maximal diversification. But what you'll find is that when you drill down into the detail, you zoom into the details of that supposed smooth equity curve of the outlier hunters, you will still see those step ups in the series over the time series, because they won't be perfectly smooth.
I wanted to bring up one more topic here. Oh, yeah. I listened to the podcast of Howard Marks. Yeah, I thought he's pretty interesting. You know, he does things in a different way, has a lot of great quotes. And I like this. I tweeted this podcast. Well, no, it was an interview, I think. And oh, yeah, he makes this one comment that I thought was interesting from a trend following point of view, the irrelevancy of this comment. But everyone says this, you know, it's you can throw these things out there and no one can respond. You can shut everybody up. Not me. Nope, not me. Nope. He says if you came up into this business since 1980, which is almost everybody, you have only seen declining interest rates or ultra low rates. In other words, you're not prepared. Yeah, this is what so many people say this. Like, how do you expect people to know what to do? Well, you know, look, I always know what to do. It doesn't always work. But trend followers are immune to the effects and implications of never having seen, quote unquote, certain things in history, you know, certain economic fundamentals. I don't need to see them. So many things we've made money on historically, I've never seen before. Who cares? You're immediately a PhD in handling the markets on your first day of trading. As a first-time trend follower, you've never done one trade ever. You are better than almost everyone else if you sell that breakout or buy that breakout. In every market, you are the expert on making money. We don't need to have any experience in anything. In fact, experience is way overrated if it's going to impact your ability simply to take the next trend following trade that's part of your system. So I'm not a fan of that cliche that people throw out there. Trend followers throw it out there. Oh yeah, trend followers. You know who you are. They say that same dumb thing. I don't like it. Then he ends. This is another thing I wanted to mention too. Hopefully y'all have some comments. We're coming up on the hour here, our 2-hour limit. He says, do you have what it takes viscerally to live with the market's ups and downs? If it's going to make you miserable, you shouldn't do it. Investment strategies have to be appropriate for the individual. You know, I think that in my Twitter and Spaces experiences with people who like to post about trading and trend following and markets and famous CTAs, etc., they get they dislike trend following. I have some friends who they absolutely dislike it because they're disappointed in it, in all the problems that it has, its consistency, its volatility, and they're ready for anything, trend following plus anything. Is there any way to make this thing fit my personality? It's making me miserable. But in essence, at the very essence of it, they really are mad. They're mad at me. They're mad at trend following. They're mad at systematic. It should be better. It's not as good as it. They want to ask me questions to find poke holes in it. No one talks worse about trend following than me. I make it my job and my goal to try to make sure everyone understands how bad it can be and how horrible it is and how you have to embrace the bad parts as a badge of honor and seek out pain, suffering, discomfort, drawdowns, profit give backs. And I think in essence what he's essentially saying is, and this is the solution for people who are very disappointed and feel miserable, and that is do not trade. Do not trade trend following. It is not suited for you. Don't invest in it. Oh my God, don't even do that. Just walk away and enjoy life. You don't have to do this. Yes, poke holes in it on your own time and think about how bad it is and how much it's let you down. But this is life. You know, I agree. But there's only one thing worse than not trend following, and that is taking trend following and twisting it up with all of your ideas to make it better for you, as if that's what you deserve. You're going to take money out of the markets, plus on your terms. You're way off base. You need to stop, go to therapy, trend following therapy. That probably is a someone who offers that. Addicts of trend following who need to be rehabilitated through therapy. All right, Absolute. If I see you in Sydney, I'm going to notify security. No, just joking.
No, we'll probably meet in the States somewhere.
Come to Australia, Absolute. Come on.
Yeah, I've never been there. This may actually be a reason to go to Australia. Yeah, I'll think about it.
Yeah. I mean, we should definitely all, I've got to get buy-in from Oleg, Richard, Absolute, Moritz, Cordura, Josh, Bruno, Billy, Jojo, Adam, all of the dedicated listeners and cult members. We got to meet up in New York City, being very American-centric here. And we'll have like a trend following. We need to put together a annual trend following conference get together, and where all of us can be in tremendous control over the agenda and how it actually.
I'm all for that, Jerry.
Yeah, let's do it.
That's a great idea.
2 days, and it'll be really fun hanging out and having meals together. And if the initial conference is like the 12 of us or less, Marcel, he was ready to come. Marcel said yes, he's ready to come. Marcel flew from Romania to France to hang out with Lisa and me and have lunch. So that's dedication. All right.
Come on, 12 is plenty. 3. I would fly for 3.
Yeah, I would too. Okay, I want to, before I sign off, I want to make sure to announce, and I'll post this more than once on Twitter, that next week is going to be Thursday. I have some work to do on Friday. I cannot get out of it. Tried, can't do it. So next Thursday, 7 a.m. Eastern Time, one day earlier. I don't want to hear any crap from Absolute next week, not getting these notices. So forewarn, put it in your calendar.
Jerry, I never heard about the date change. I'm so sorry. Just kidding.
Exactly. Okay. 7 a.m. next Thursday, the 19th. If you want me to put you on the calendar, I have a calendar for this, and I've invited some of the listeners, and so they know exactly when I change this on my calendar. My calendar rules. I'm a calendar person. So send me your email address. I'll put you on my calendar so you'll know exactly. But you got to become a calendar person and submit yourself to your calendar. All right. Have a good weekend, everyone. It's been fun. Great discussion. We'll do it next week. Wouldn't miss it for the world. Keep being dangerous, but keep those attacks to a minimum. Thank you.